This is Javier Flores with Keller Williams Realty. Here's Bob Brenner with Guild Mortgage on this week's Mortgage Market Update.
Hi, Bob Brenner, Certified Mortgage Planning Specialist with Guild Mortgage. I'm going to talk a little bit about Guild Mortgage, what we do. We're a direct lender. We do VA, FHA, and conventional loans. On our VA loans, we're a VA automatic lender where we underwrite and fund the loan, and 9 times out of 10 we service it as well. FHA, we're a direct endorsement lender. Same thing, we fund and service those loans. We deal directly with Fannie Mae and Freddie Mac on our conventional loans. We also provide jumbo financing as well. 30-year fixed, 5, 7, 10, the whole gamut of what you can find out in the market we provide. Anyways, purpose of today's update is to give you an idea where we think mortgage rates are going to be going next week, for the remainder of the month, and even in the next year. So before I lose you into the weeds with a lot of the lender lingo with mortgage-backed securities, which is a part of the overall bond market, and we'll get into some charts. If you're interested in getting a weekly update or even a daily update where rates are going, feel free to reach out to me. Send me an email at bbrenner@guildmortgage.net, and we'll get you signed up on. You'll see the same charts that I use and determine whether or not to lock in an interest rate or float. So hope you enjoyed it. And again, if you have any questions, feel free to shoot me an email and we'll answer anything, or give me a call at 805-427-3538. That's my cell. Take care.
Well, hello, folks. What you see here in front of you is a mortgage-backed security chart for the Fannie Mae 30-year 4% coupon. Now, what the mortgage-backed security is one part of the bond market. The bond market is also an offset or trades with equity stocks. If stocks are doing well, the bonds are usually doing poorly, and vice versa. If bonds are doing well, stocks do poorly. Bonds cover U.S. Treasury bonds, state bonds, corporate bonds, Treasury securities, and what have you, and then what lenders use to determine mortgage rates, mortgage-backed securities. And what we want to pay particular attention to is where this little channel here since about March 20th. Why is this important? Well, rates haven't really been doing much the last couple weeks, up until you can see it's been kind of going up and down a little bit. And the anticipation for rates over the next few weeks and months to come, and even a year out from now, is this. Rates will gradually increase. We're now running about 4.5% at 0 points for a standard 30-year fixed rate loan. More than likely by the end of the month, they're going to be up to about 4.75%. And by this time next year, they should be in around the 5.5 range. No one's anticipating they're going to be skyrocketing anytime soon, but the trend is still up. Now, why is that? Well, back in November of this last year, the Fed was purchasing $85 billion a month of treasuries as well as mortgage-backed securities to help support the economy and keep it from falling back into recession. Well, they decided that the economy is improving enough where they can begin what's called tapering, buying less, to the tune of $10 billion a month over the next remaining number of months until next year, to the point where they're not buying any more of those. So rates are going to gradually increase, as they hope, as employment improves and so on. So back to this. We've had really no direction, a lot of stuff overseas with the Ukraine and the North Koreans and what have you, in terms of foreign money coming in and helping support the bond market, which is usually considered a safe haven for investors to park their money in times of potential turmoil. But the economic reports nonetheless have been suggesting that we've been ever so slightly improving, and consequently the prices for bonds will go down. Now, what that means in green here is when prices move up, rates go down. In red, bond prices go down, therefore rates will move up. It's an inverse relationship. What we've had here is a really narrow channel, and up until the beginning of last week, the bond market was thinking, okay, well, the foreign money was going to keep coming in because of the stuff in Ukraine, but now they're starting to focus on the upcoming March employment report that was released last Friday. More about that in a moment. So in anticipation that they're thinking the economy was improving, the employment would improve, therefore people would be making more money and then spending more money and causing inflation. Inflation is one of the key elements that bond traders are real leery about, because inflation eats away at the value of their investment. So if they think inflation is going to come back, they're going to start selling off their investment, sometimes at a loss, and that's going to cause interest rates to move up. So what happened was, in anticipation of that employment report, they started to think, okay, rates are going to get higher because, or they'll go higher because more people are going to be returning back to the workforce. Well, what happened was on Thursday, some foreign concerns, meaning money came back in the bond market, so it improved a little bit. And then Friday, the employment report came out, not as well as as expected it should. Consequently, the bond market rallied, thinking they have a little bit more time, and bond prices went up. Rates have come down to about 4 3/8, 4.5% at 0 points. And then again today, the stock market was off by about 150 points, and that money moved out of the stock market into bonds. What does that mean to you as a buyer? Well, you still have a window of opportunity to get a home at a good price and rates that are still competitively priced. Not as low as they were back in November, but still near historic lows. So that window of opportunity is still there, but rates will probably increase over the weeks to come to about 4.75%. And the general expectation, as I said before, is this time next year, rates are going to be about 5.5%. So that's why I say that if you're going to look to purchase a home, you really have a great window of opportunity now. If you have any questions, feel free to give me a call at 805-427-3538, or shoot me an email at brenner, that's BRENNER, at guildmortgage.net. And if you like, I can even sign you up for this chart. You can watch the same charts that I use every day to determine whether or not to lock in someone's interest rate. Take care.